they have no point of reference. Now, time to open another trade. Market goes against you, have no point of reference, another loss. A loss after a loss after a loss. What we do, we take a profit after a profit after a profit after a profit. That's the difference. Next component is getting out. Basically getting out with a profit.
Yeah, with your shirt on.
And the rules are very, very simple. This is a lot simpler than the trade entry. Trade exit, basically when in profit, rule number one, when in profit, take profit when the range or rectangle bar changes color. Simple as that. When in profit. If you're not in profit, guess what? Never mind. If you're not in profit, all right. There's going to be some other things that will need to happen. But when you're not in profit, don't worry about this. As if you're not in profit, as if nothing happened. But when in profit, take the profit. Do you know why?
Well, that's what the name is.
Yes, but do you know why you want to take the profit when the bar changes color?
Because it got reversed.
Well, you could lose it, right?
Give it back.
Now there's an option here that the more experienced traders might exercise, and that is to put a trailing stop on your trade. I call it a profit stop, not a stop loss, but a profit stop. And depending on how volatile the market is, you might allow the gap between the market and where you place the stop to be wider or narrower, depending on what you're trading. Again, if you're trading pound yen, there's a lot of noise, a lot of volatility. Allow yourself as much room to wiggle, or as much wiggle room as possible, without completely eliminating your profit. Now, the software has a really unique profit trailing feature, which is built into the deal formula. And when we go over that hopefully later this afternoon, then you'll be able to really do neat things the way you set your profit stop with that. Manually, it is extremely difficult to do simply because we have features where if we set the profit stop at a certain price, and then we can trail the market depending on how we set it, and it's almost like ratcheting it by different amounts. Or say, for example, the market moves 3 pips, you move the profit stop 1 pip, or 2 pips, or 3 pips. If the market moves a pip, you can move the stop by a pip. Or you can set it, if the market moves 10 pips, you move the profit by 5 pips. Right? So you're actually widening the gap between the profit stop and the market, allowing more room to play, and hopefully not to get stopped out to work. Right? Here.
The range bar change, you call it that when it bar completes or at any time?
When the bar, the completion of it. Everything is completion of the bar. And so let's look at it, right? We entered the market here. Bar changes color, we're out. Wait for another opportunity. Bar changes color, we're out. We're out. Out. first time it changes color, we're out. Now, here's why. Way too many times I left too much money on the table, and then it was like watching the hourglass go up and down and up and down and up and down, just not making anything, wasting time and not making anything. I would much rather make 5 pips 50 times over in a day than waiting for 20 pips all day and never hit it. Right? Because you've got 15, then it goes down to 5, maybe you're down a little bit, it goes up, it's almost 20, then the market reverses it. And I'm waiting and waiting and waiting and waiting, trying to hit my 20 pips and never hitting it. There were many a day when I was just looking frustrated, looking at the market frustrated, just like you mentioned, the market be doing this and never hits my target. So I just, if I have a profit, guess what? Now suppose, okay, suppose that this market wants to run up and I get out. There's always an opportunity. There's always an opportunity to get back in. So take whatever the market gives you and have another opportunity to when it comes to more high-frequency trading, it's a lot easier to do it when the software does it. Because software doesn't procrastinate like people would. Especially when you've got 5, 6, well, the market, will it give me another 2? I've got 8 pips. Well, at least give me at least 10. Right? And then 8 pips turn into 5. And you're like, darn. And then it goes back down to 0 and you've got, all of a sudden, you've got nothing. You might be down 10 pips. Now you're waiting again until it gets back up. Well, by that time, I'd have 2, 3 trades already. I'd rather make 5 pips 3 times than not make anything. So, when in profit, and notice where this market is changing color, or what chart this is. This is the same chart that I'm using for trade entry, for my trigger. Now, when I'm not in profit, I will be using my short-term trend chart to do my hedging. When I hedge. Okay? So when the market or when the bar changes color, get out with profit. If you're not in profit, basically remember at this point you only entered with 1/5 of the position than normally you would, correct? You remember that, right? So suppose at this point the market reversed and went down against you, but all the conditions are still in place for you to open long trades. So let's just assume right here where this pointer is, the market reverses and goes down. And right about here, it gives you another signal. Now, provided that your daily, I'm assuming the daily would still be the same as on the original trade, and if the hourly is still the same color as the daily, you can come back in and enter it if you're not in profit. Now also, if you have a trade that is what I call protected, in other words, there is a trailing profit stop on it, then you can also enter at any time because that trade is no longer at risk. Any trade that is at risk, we call it a naked trade. Any trade that is protected, we call it a free trade. That's a freebie. That's already in the bag. Right? So don't try to have more than one naked trade. Any questions?
Yes. Can you repeat, you said if the market had dropped down and conditions were still what they were to begin with, and you could take another trade at the same size that you had done
Right,
before?
right.
So it's not a matter of pip distance at all it's not a matter of range, you don't take that into consideration at all?
Yeah, it is to a degree, but if the market is strongly trending, then it doesn't really matter, particularly on the first and second addition to that position.
Have you ever found yourself too close to each other that did that matter?
Normally you would have, depending on the volatility of the pair you're trading, you would have a trade, what we call a trade interval on pound yen. It would be somewhere between 50, 75 pips or so between those individual trades. On euro dollar, you have probably 25 to 35 pips or so.
And you just set that up in the software ahead of time, right?
Yeah, you do. Every harvester, which is a trading sequence that begins with the first trade and ends when all the trades close, has a field that actually calls for 3 different variables that specify that trade interval. And those are different types of trade intervals. One relates to the trades from the very same harvester. The other one relates to the trades from the same harvester ID but a different run. And 3, it relates to trade intervals from different harvesters in the very same open deals window, if you know what I'm talking about. So there's all those 3 parameters that you can specify, which deal with how close the software will allow you to open trades of the same family in the same direction, in order to minimize the number of naked trades. Now, if your trades are free, if you have established a bunch of free trades, meaning they're protected. Now, think about this. Initially, I said you want to limit the size of your position to 10% margin of your available capital. Now, suppose all of those trades within that margin are protected with a trailing stop already in profit. Do you think that rule still should apply? No, of course not. It doesn't matter anymore because you have those trades protected and there is no risk. They are not naked trades. That rule only applies to naked trades. How much of your margin would you want to have invested in trades that are protected and you cannot have a loss on all of it, right? That's the idea. And that's when we pyramid into a position. And that's what the software does better than anything else. If the market is cooperating, then these individual trades that I'm saying only open a trade with a 20% of the margin that you have available, not the margin that you have available, but the margin that you allocate per position, right? As you're pyramiding into a position, adding onto a position, every time you add to that position, you're protecting the previous trade.
The basic concept upon which the harvester module was developed is that when the market is trending, the harvester we create recognizes our signals and captures or harvests profits from the trend. With the software, the trader has the ability to build a position in the direction of the trend by opening and subsequently closing portions of positions in profit and letting the remaining portions run by protecting the remaining open positions with trailing stops. it can continue placing more and more trades in the direction of the trend, and closing and/or protecting them until such time as the trend changes. In short, the Harvester module builds upon the manual deal in a way that allows us to build positions in trending markets and extract profits automatically.
So everything, you only have one trade that is naked, which adds to the overall position. And this way you can almost like snowball your profits, right? And that's when this particular rule doesn't apply anymore. This rule, the maximum amount of capital in margin for open trades only applies to trades that are naked. So we understand each other. If they are protected with a profit stop, doesn't apply. Doesn't matter. Throw all of it in. Go all in if you can be protected. Because then there's no risk. Right? Everybody understood what I meant?
Where's mud? Where's mud?
So this is a lot easier to do with an automated system than manual. All right. So when in profit, we take the profit. When not in profit, next rule: if not in profit, improve your position or your cost basis with dollar cost averaging, maximum 4 other times. Why 4 other times? Because that's all the margin you're allowed to put in one position. Plus, observe the minimum trade recovery interval. The minimum trade recovery interval is basically we call it short trade interval, and the software does that automatically. Now, as for you, when you're doing manual trading, you have to be mindful of that. Just like Dennis asked in this last question. So he correctly pointed out that there are certain rules that we should observe in terms of not to put in a flat market or range-bound market, particularly when going back here. Like for example, if I had entered this trade at this point, let's just say that what's this price over here? This price is 1.3375. 1.3375. I entered this trade. Well, suppose that I wasn't able to get out. Suppose this trade is still open. I wasn't able to get out, and I have the next trade opportunity over here. Am I going to add this trade to this trade? What do you think? No. You know why? Because guess what? The price at which I'd be entering would be what? Pretty much the same price. Let's call it 1.337. Well, if I have 5 opportunities to improve my cost basis, 5 opportunities to enter into a new trade, to add to my position, I have to be mindful of the fact that I don't want to have all of my trades too close to each other. Because what is the average cost basis here? 1.33725, right? Is there any advantage to that? Not really. I already have this trade open, but if all the conditions to enter a new trade were at, say, 13325, there's a 50 pip difference between the two trades. Yeah, I take that trade. I definitely take that trade. particularly when the conditions are still maintained. And I'm talking my setup number one, setup rule number one, and setup rule number two. Primary direction and short-term trend. Then I would take that. And that's when we talk about trade recovery interval. All right. The same entry conditions are still present. Always keep in mind that you add onto an existing position only and only if the entry conditions are still present. Never dollar cost average when the trend has reversed. Ever. Don't ever do that. Any questions on this? You have total of, yeah, go on.
Are you going to talk about setting up protected trade?
I'm sorry?
Are you going to talk about how to set up a protected trade?
A protected trade is very simply putting us, I can go back, putting a trailing stop on a trade. Give you an example. Oops. We entered this trade at 13375. Now, the market is turning. Normally we would exit, and let's just say the price here would be 13415. Right? What's the profit? That's a 40-pip profit. Well, what I might do at this point, instead of exiting this trade, I might put a sell stop on this trade, enter a sell stop at, say, 133.85, for example. So I maintain a minimum profit of what? How many pips? 10, no matter what happens. If this market reverses, and as it in fact did in this particular example, I would have been stopped out here, right? But if the market decided to go back in this direction, then the chances are I would not be stopped out and my profit stop would not be triggered or would not be filled. And then I could, with the trailing stop, I would be basically trailing that profit and increasing the profit as the market is moving out. Now with that trade protected, I could easily come in here and enter into or add on to my position here. If this trade was protected, then I would enter this position, I would add on to my position with this trade over here. And then all three trades would be working for me. And I would have it protected probably as soon as this one. If I see that this one's protected, this one's protected, I probably wouldn't wait until the market got up here. I'd probably protect it after 40 pips, just like we did here. And then you could just add on. If this market were to continue to run, then you could have 100 trades added on to your position, as long as your account could handle, because then every trade is protected. Maximum one would be naked. And which one would that be? The last one. The last one would be naked, because it's not protected yet. As soon as you protect it, you look for another opportunity to add on to your position. That's how you make the big money. Now, there is a danger in this. And you know what the danger is? Actually, it's not a danger, but there's a risk of losing, like, if you look at this trade right here, all right, you have 40 pips if you had closed it. If you had closed that trade, you have 40 pips. If you protect it with a trailing stop, you lose 30 of those 40 pips and only end up with 10 pips because you get probably over here, if not here, then somewhere here, you get stopped out. You see what I'm saying? So you would lose those 30 pips that you already had. But you know what? Nobody's got a crystal ball. Nobody knows. Because you don't see what happens. When this is happening, you're right here. You don't know what's coming.
Joseph, along the lines of taking profit, I noticed a lot of times in the software that you did partial closes. Are you going to address that later, or is this the time that you wanted to address it?
I suppose I can.
And what your thoughts are and how you do it?
It's like this. It's a double-edged sword because the markets can be very volatile. And what you need to do, and I can't really address this with 100% accuracy because what I do today might be different tomorrow. The same market will behave completely differently tomorrow. So there is not, or at least I don't know of a rule that you would follow where you would maximize the profit by sometimes entering trailing stops and sometimes not. You see, you know what?
So you just have a strategy that always does it one way?
Always. Whatever I decide, what I'll do, I'll run a strategy for a month.
See what it does.
And then I'll run it with profit stops and without profit stops. And I'll analyze and find out which one made more money, and then I'll just dump the one that made less and just run with that one. And you know what happens the next week?
It changes.
Of course. But there is no rule that will, because here's what you know, this market has a mind of its own. It is going to do whatever it wants to do, and always will do it that way. And usually it will be not what you want, or not what you're preparing for. It will be usually the other thing. Because, all right, so we've got a situation. The other option of protecting this trade that's 40 pips in profit is, let's just say that you open this trade at, 1 mini lot, right? You've got 1 mini lot, 40 pips in profit. Well, what do we do? Do we take the profit or do we protect the trade? If we take the profit, we've got 40 pips in the bank, in the bag, in the account, in the bank, right? Now, we are if we were to protect it though, and the market keeps running up, this is one of those things. We already have a trade closed, we've got 40 pips, but maybe we left 100 on the table. Right?
Yeah.
So let's not protect it, just take it off. All right? Well, we take it off, the market runs. If we protect it, all right, the market retraces, gives us only 10. Another option is take half or a certain portion of this trade off the table. So in other words, if this is 1 mini lot, take 5 micros off the table, take 40 pips on 5 micros, right? And protect the other half of this position. See what I'm saying?
So, really what you're saying is, if you could play any sport and take second place consistently forever, you'd make more money than somebody who occasionally gets first place every once in a while.
And isn't Isn't that the case though?
It is absolutely cheap. And that's brilliant when you create that and have figured that out with the long run.
Well, there's really three options. Which one is the best? Usually not the one that you select. But the second best option is still okay. We still make money. And once in a while we catch the run. And that's the fun. That's the fun part. It's a lot easier to manage the trades when they are in profit than when they are underwater. I tell you that. I mean, honestly, it's a lot more fun too. So, you know, maybe I didn't make $100 on this trade, I only made $50. Well, but still, $50 is better than being $300 in the red, right? So, you know, there's several options that you have, but when I say when the bar changes color, you need to do something. Take profit, and when I say take profit, also protect the profit. Or take some of it and protect the rest. That's what you had in mind, Dennis, right?
Yes.
Yeah. So you've got one full lot equals 10 mini lots, which equals 100 micros. So in other words, when you're trading one mini lot, that equals 10 micros. So if this is a one mini lot, you want to take some profit off, take the profit on 5 micros, and you still have 5 micros working for you. They may get trailed down, stopped out, but they may still run. And that's a feature that we have in the software, and nothing does it better than the software. And you can specify, in the software, you can specify if you're trading one mini, how much of that position you want to take profit on. 1 micro, 2, 3, 4, 5, 6, 7, 8, 9, any of that. I would like to have, you know, you're trading 10, take 5 off, protect the rest, add on to your position, next opportunity. Do the same thing. And then eventually you're going to hit your ultimate profit target for that sequence, and then everything closes and the whole sequence starts again. There was a question here.
Yeah, and Joseph, at what point do you actually protect your trade? After you reach a certain...
After you reach a certain profit, or after the market reverses. The software, basically the software does it both ways.
You can do it manually as well?
We're trading manually right now. So all of this without the software you can be doing manually. You just basically enter right here. If this is a long position, at this point you would enter stop sell, right? Stop sell at this price. If you open the trade at 133.75, you want a minimum of 10 pip profit, then you enter the stop at 1.3385. If you wanted a 20 pip minimum profit, well, the stop would be 3395. So you got to do all of that in your head.
Your software have an automatic, or does it have a system, for example, the 40 fixer, is it in type of setup so it says, hey, this is a pretty good one. You know what, it would be smart for us to take 50 of this now, lock it in, put the protection in place, and if it keeps going great, if not, then we only have the other side that drops down.
Of course. Of course, that's the easy part. It's the simple stuff. It does that with, got basically the opportunity to take profit or to protect our position. Well, when you protect the position, you're running the risk of getting stopped out with a smaller profit than you had when the market first turned. Just keep that in mind.
Joseph, can I make a point real quick?
Yeah.
As a self-trader, the thing that's great about the software is it doesn't get caught up in the mess that you get yourself into. It continues to look for trades and still does it. As a self-trader, when you get down, you're automatically focused on getting out of that.
You're bogged down and your mind
And you're not even
stalls.
thinking about these other opportunities, so you leave all that money on the table. That's what I like best about the software.
Right. It does all of these tasks independently of each other without bogging the system down. Yeah, that's a good point. Thanks. All right. So we're back over here. If not in profit, improve your position, but only when the entry conditions are in place. All right. Now, we're going to, basically we're talking a little bit about dollar cost averaging. We already talked about that, but here's an excellent example. And the example is, we entered a long trade right here. Obviously, the market's not cooperating. Reversed, went down. Well, we're assuming that on the 60-minute chart and the daily chart, the conditions are still intact for a long entry. And as our confirmation over here crosses to the upside, we have another opportunity to enter. Now, we're specifically looking at the trade recovery interval. In other words, how far apart your individual trades should be in order for you to add to an existing position. If it is too close, you don't really want to do it. Well, this particular interval right here is, what's this price? 136.50, and this is 136.80. So this particular trade interval right here is 40 pips, right? So the average position, or the average cost of this position, combined position, was at right here, the middle price, right in here. And you basically break even here. At this point, you're in profit, and obviously, worst case scenario, I don't know what that price would be, obviously, but worst case scenario, you break even here, even if you had a terrible entry at this point.
So is there like a rule of thumb to define that minimum gap you want between two entries?
My rule of thumb is you want to look at the average daily range of a currency pair and divide that by 5, and not have any entry that is less than that. You don't want to have the trades spaced out less than that amount. So let's just say that you've got a pound yen that is trading at 200 pips a day average. So you've got about minimum 40 pips. All right. So original trade is intact. That's why you can add onto the position, because this position naked. Dollar cost averaging, really with this trade interval in place, is important. The trade interval is important to consider on naked trades, not on protected trades. Protected trades doesn't matter because they're protected, they're not at risk. And minimum trade recovery is the difference or spacing between two trades, minimum 1/5 of the average daily range. I think, Gary, that was the question you were asking right there, so you were just slightly ahead of it. So if the euro is averaging 100 pips a day, what would be minimum trade interval? 20. Now, that doesn't mean that you have to have 20. That's minimum. That's the minimum. And maximum 4 dollar cost averaging trades. Why maximum 4? Well, the first one is your original trade. That was 20% of your margin for the position. Not available, but allowable or allowed margin. And then you've got 4 other ones. And they're going to be spaced out at least minimum throughout the entire average daily range of that currency pair, right? So now you can appreciate the wisdom of that. Because even if the market runs against you, you're not as much down as you would have been had you put all of the margin into that one big position. And it would be a lot more difficult to get it back. Because here's something that also can happen. Let's assume that from this point the market goes down. And then it will go up again and go down. Let's just say it will stay in this 40-50 pip range. It won't break out of that for a while. Well, you might not be making a whole lot of money, but guess what? You'll be able to take small trades. Let's make another assumption. Let's assume that this market didn't quite run all the way up here. That it ran up, say, about half the distance. You wouldn't have made 40 pips from here to there, but only about 20. Well, guess what? The same rule applies to the second trade. You would take 20 pip profit on this trade. That means that this trade now, if the market were to drop all the way down here again to where you opened this trade is still 40 pips down. You're still 40 pips down on this trade, but you took 20 pips here. And then you get another opportunity maybe over here somewhere and take another 20 pips. Well, guess what? You're even. Even though you still have a trade that's open that's minus 40 pips. You take another trade and you're 20 pips up. Yet you still have a trade that's 40 pips down. So you can make all these small trades with the additional margin which you wouldn't have had available. You'd be waiting here forever for this trade to come back up. As long as your conditions are met. Because if the conditions are not met, guess what? This market's going down. That's the other option. Well, if it's going down, guess what? We're going to start trading short. Have to. You follow the rules each direction identically. Now, and you might get in a situation where, guess what? This trade is still hanging out there, but you've made 4 or 5 trades that are little 10, 20 pippers, right? And you're on the aggregate position, you're plus. Now the market reverses, you put on a hedge, and when you actually hedge, you hedge yourself into a positive position. So you hedge, yet you can just collapse those 2 trades, the 2 opposite trades. You can just cancel the hedge out, and you're in profit. You don't even have to follow through with the hedge at that point. Right? Because you've taken all of these little trades, which is a lot easier to do with an automated system than to sit there 12 hours or 18 hours and do it myself. Right? All right, so let's move forward. We went over these rules, tried to maintain or be mindful of not having the trades too close to each other if they are naked. If they are not naked, it doesn't matter. Right? All right. Rule 3. If not in profit and originally entry conditions are no longer intact, apply hedging when Fibonacci bar changes color on the trend chart. Which is our trend chart? Short-term trend chart. Which is that? Our 60-minute one. When the 60-minute, when the color of the bar changes on the 60-minute, we automatically go to hedging. Now some people say, well, you can't hedge in America. When is that going to come out? And the answer is yes, you can. Yes, you can.
Yes, you can.
I'm not going to be asking my... Okay, here's something that you need to understand. Please don't ever ask me again how it is possible that we can hedge. Because it's illegal. It is not illegal. All of these big brokers in the U.S., there's about 25 of them or so. They got together one day and they said, you know what, guys? We're big, we're strong, we're the big, 600-pound gorilla in the room. We need to get all of these little guys out of business. So what we're going to do, we're going to form our own little cartel. We'll call it NFA, National Futures Association. And we're going to set our own rules as to how trading should be done. Now, and those people that don't have the money to be members with us, guess what? We're going to blackball them. We're going to say everything bad about them. They are not really good brokers because they are not our members. And we're going to set these rules in such a way that benefit us and not the traders. And by the way, we don't like this hedging crap that the traders are doing because I'm sorry?
It gives the traders an
because
advantage.
not that it gives them advantage, but it just helps them protect their money better. Right? It helps them protect their money better, so we don't like that. We want to take their money as quickly as possible. Now, and all the companies that are part of our little cartel, and we're going to go protect each other, we have to stick together. We have to, stick to these rules. But interestingly enough, so bottom line is people think that this is, when NFA NFA puts out rules that these are some kind of constitutional laws, or they're nothing. They're nothing. I mean, think about this. How many of you have had 2 accounts with one broker? Right? Now, Dennis, is it possible that in one account you can put on a long trade, and in the other account you can put on the very short trade? But if you try to do it in one account, both long and short, they won't let you do that.
Right.
Now, how in the world is it illegal if you can't do it, but yet they don't want you to? What NFA says doesn't mean beans. But we don't have to ask their permission. We do whatever we want on our own platform, because it's our platform that keeps track of all these trades and, you know, keeps them all open, even if the broker closes them or pairs them out. And the reason why, I'll show you why it is advantageous to them if you cannot hedge, or if they prevent you from hedging. All right? So let's look at this chart. And this is euro dollar 60 minute. Right? Why 60 minute? This is our short-term trend chart, right? We're assuming the market was long over here. We had a daily green candle, green bar. Everything's going fine, and it's going fine up until here, and then we've taken some profit, and over here we get into a trade. Well, but when this happens, we don't have a crystal ball. We don't know what's going to follow. Well, unfortunately, the market is going to reverse. And now the market has reversed. So, we're not in profit. The trade is open. Trend reverses on the short-term chart, short-term trend chart. We enter a hedge after the first red bar. Now, let me just assume some pricing. Let's just say that we entered into this trade over here at this price. Can you read it from the back? What is it, 136.80? Yeah. So here we are. We're in the trade at 136.80. Well, market reverses, we enter a hedge. Let's just say at this price. What is it? 136.60. So this is a long, this is a short. 136.60. Now what the broker would like you to do is completely forget about this ever existing. Because when you pair up these two trades, guess what happens? You just took a 20 pip loss. Right? If you take 10 of them, that's what? 200 pips. And you take that 10 times, that's 2,000 pips. That's the way the brokers that have the B book that trade against you, which is most of them, would like you to trade. Take 20 pip loss here, 30 pip loss here, 10 pip loss here. Don't take big losses, take little losses. Now, most people, well, it's illegal to hedge. They basically, oh, well, that was a bad trade. And they wait for another opportunity to do the exactly same thing again. Now, the software, or you can do this on paper. You can do it manually. Keep track of this manually. We just did. Okay? These are our records. Now, the broker will show in your account, in your brokerage account, will show what? Nothing. You got in at 136.80, got out at 136.60. 20 pip loss, thank you very much. But we look at it different. We put on a short trade right here at 36.60. Market goes down. We will exit this hedge when the trend returns to its original direction, which would be right there, based on all of our rules. What's this price? Let's call it right here. This is 135. 135.40, right? This is our hedge. We entered at 136.60. We close it, exit it, because the market's going back up again. Assuming that the daily candle is still green, right? Market's going up, exit hedge. Now, would it be safe to say that this hedge is in profit? The second trade?
Yes.
Right? How much?
120.
We just made 120 pips on our hedge. Now, by doing this, keep this in mind. We close this trade. We no longer have it. But what we do have is plus 120 pips in the bank. Now we still have this trade that's open. What's the price? Same price, 136.80. Now guess what? Market's going up. Now it's reversing again. So it reverses, and right here at 135.80, 135.80, we get out of this trade. Do you know why we get out of it? We're actually collapsing the next hedge. Right? Why we get out of it? Because even if we lost 100 pips on this trade, we already made 120 here. So when you add them together, now I'll tell you this, I would much rather have a 20 pip profit than a 20 pip loss. And that's all the difference in the world. Right here. Right? So when you enter this hedge, basically, because the market's reversing, you're already in profit. You can care about and close them out. Because you do not need to keep track of this anymore. Now most people, the way they trade, they open a trade, the trade lost, the trade loses, they have no point of reference. Now, time to open another trade. Market goes against you. You try to hedge it, they won't allow you. You have to take the loss, you have no point of reference, another loss. A loss after loss after loss. What we do, we take a profit after a profit after a profit after a profit. That's the difference.